Yes.
Is it very clear? Oh,
Ay maganda.
crystal clear. Okay. As usual, let me invite a couple of people to switch on the cameras so we can at least kind of have a bit more energy to start off.
Mama Giot, arang nenda pula Mama.
So let me mute the person. Right. Anyone who want to switch on the cameras in the early morning? I think we have about 33 participants so that we can start off without any further delay. So great, Callum. So good morning to all of you. And today also we have 2 sessions. So you are listening to the same voice till 5:30. And let's see how it all goes. But to begin with, before I do a recap of what we did in the last session, do you all have any questions to clarify? It's very simple. If I know the answer, I will tell that answer. If I don't know, then I will read some books to get the answer or contact probably an expert to get the answer and share with you. Okay, and in the middle also you can ask questions. What we did during the last session? Right. I think we we talked about a bit of history, how accounting emerged, and Luca Pacioli, the father of accounting. And also we talked about the relationship between financial accounting, management accounting, and finance. And then we talked about business realities. There we talked about the classic business case or corporate scandal, that is Enron collapse. And then the auditors' involvement there. And Enron was audited by the largest audit firm in the world by that time, called Arthur Andersen. And external auditors, should play an independent role, independent third party, but they were bribed. And today we don't see Arthur Andersen because their independence was questioned, and no one else would step into Arthur Andersen to get an independent audit opinion. And we talked about agency problem in that case, because the owner of the business and the management of the business in most of the businesses are 2 separate entities. So owners need profit and the managers need their perks, benefits, salaries. So we talked about that when the things are quite all right, we can't see any big problem. But when the things are not all good, then to safeguard managers' positions, perks, benefits, then they try to inflate the profit, inflate the asset base. In simple terms, they try to showcase a falsified picture to the owners of the business. So this doesn't happen in a retail shop. Like, you are the owner, you are the manager, you are probably the cashier, and you are everything if you think of a retail shop, nearby retail shop. But in large corporates, we talked about people like Aravind De Silva. They are businessmen, so they dump money to businesses, but businesses are managed by different set of qualified, competent people, and putting the trust on them. But to safeguard the owners, there are accounting standards, auditing standards, regulations and rules, and also independent third party to examine the accounting records. So we talked about that agency problem as well. And then we talked about some of the, and you listed your accounting terms, I would call it, accounting terms in the Padlet. And we went through the accounting terms, and that gave me an idea that even though you have not done accounting, or at least I think 95% of you have not done accounting, but you have an understanding of accounting terms. And then we talked about some of the accounting terms, assets, liabilities, and we talked about assets. We talked about liabilities, and assets are the things that are owned by the business that brings future economic values, controlled by the business that brings future economic values, or right to receive economic benefits. And there are assets that are that are more long term. There are assets that are short term. Long term assets are like machines, buildings, furniture and fittings, land. They are owned by the business organization, and then they bring economic value to business, but they cannot be converted into cash or cash equivalent within a very short period of time. So more than 1 year is called non-current assets or long-term assets. But if there are assets that can be converted into cash or cash equivalent within a very short period of time, then we said it's current assets, or non-current assets or fixed asset, current assets or short-term assets, like bank account balances, the cash that you are having in hand. And if you have short-term fixed deposits, then they are called, your debtors are called non-current assets. Sorry, current assets. Then we talked about liabilities. Liabilities are the responsibilities where economic there is a obligation to transfer economic benefits. And again, liabilities are twofold: short-term and long-term, or current liabilities or non-current liabilities. Now, if you take a 5-year bank loan, that's a non-current liability. But if you take a short-term bank loan, that's a current liability. Creditor is one example for current liability. We talked about debtors, creditors as well when we're talking about the accounting terms. And also, thereafter, we started building the accounting equation that was part of the double entry system introduced by Luca Pacioli in 1494. And double entry system started with we started with a basic equation, that is assets equals liability. Assets equals liability. Then we expanded that to assets equals capital plus liability. Assets equals capital plus liability. And then we talked about capital. And when we are talking about capital, we talked about the entity concept. An entity concept says that the owner of the business and the business entity are two different parties. Owner of the business and the business are two different parties. So the business has a liability towards the owner for the money that the owner is putting into the business. So the name that we have given to that liability is called capital. So whenever a business is started, then the owner is dumping money to that business, and business is liable to pay that money back to the owner, and that is called capital. So whenever owner put money into the business, then the capital portion of the business will increase. But from the business point of view, it is their liability. But we don't call it as a liability, but it is called as capital. So that is part of the entity concept, because owner and the business are two separate entities. So with that, I think we concluded the session, after going through this accounting equation. And then we did a small question. I think example number 1 we did. Oh, probably not the example number 1. Let me check. Mm, yeah, we discussed the example number 1, but I remember that we have not done it in the classroom, but sorry, we discussed the example number 1. And also, I gave you a couple of tasks to you all. First one is, can you remember 2 tasks that I gave you the other day? Still valid? Still valid?
Statement report.
Sorry?
Statement reports review.
Okay, I ask you to find an
Concepts.
annual report. Right? Another one? Can you give me a second? I'm getting a call. Yes, I ask you to find an annual report. It would be great if you could find a physical one. I don't know nowadays. Finding these papers are all that not all that easy, but you can find an old version of an annual report. That's fine. Yes, I gave you another task, I think.
Accounting concept.
Ah, brilliant. Yes, I wanted you to collect information about accounting concepts. Have any one of you done that?
Yes.
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 Fantastic. Brilliant. So that is still valid. So if you can get those, if you can collect the accounting, read through the accounting concepts and prepare a note, the benefit is not for me, but for you. Then you will get to know more details about accounting concepts. And also if you have an annual report with you, then you can refer and you can familiarize, and that that is important, I think. Okay, then. So let's move on to today's session. I will share my screen. I have a bit of wheezing, so that's why that for. Can you see the screen? Okay. Did I ask you to put this into the accounting equation? Have any one of you done that? No. Okay, right. So let me ask this question again. Can you remember the accounting equation? Can you remember the accounting equation? No? Any one of you?
Asset equal to equity plus liabilities.
Yes, assets equals to equity plus liabilities or capital plus liabilities. Assets equals to here, assets equals to equity and assets equals to equity plus liabilities. Equity is the amount of money that owner is putting into the business. Now here, this one we discuss. Owner invested 8,000 cash as capital. And also we discussed this when it comes to accounting transactions, accounting transactions always have this dual effect. Accounting transactions always have this dual effect. Dual effect. In Sinhala, we call it Dvitva Satahan. Dvitva Satahan or double entry. Dual effect. So it is going to every accounting transaction or every business transaction. Accounting transaction in the sense every transaction that carries a value, a monetary value. Okay, so these transactions always have this dual effect. Now, when we say owner invested 8,000 cash as capital, now we need to look at from the business point of view. So, okay, there is a business and there is an owner. Now, owner is a separate person. Owner is a separate person. Okay, and we prepare accounts from the business perspective. Now, when we look at these annual reports, now let's say the company is John Keel's Holdings. It's John Keel's Holdings statement of profit or loss for the year ending 31st December 2022. It's not John Keel's Holdings owner's name. So it's John Keel's Holding. Let's say it is Shanta Stores, probably Shanta Mayadunne may be the owner of that business. But when you prepare the accounts for the business, it's Shanta PLC's statement of financial position as at 31st December 2022. So you prepare account for the business and we need to look at from the business point of view, always from the business point of view. Now, there is a business and we are looking at the business point of view, and owner, a third party, someone outside the business investing 800,000 cash as capital. Yes, he's the owner. And now business is getting cash. So you have an asset called cash. And on the other hand, now this is the owner. So you have a liability to pay that back to the owner. So that liability is called capital. Cash from your left side, then right side, capital. The equation get balanced. Then purchase furniture 10,000. Furniture is an asset. So your left side, one asset to create as furniture, and now you are paying 100,000 to get that furniture to your business. So you get one asset called furniture and you are losing another asset, that is cash asset. So now the cash amount is not 800,000 but 700,000. Then obtain a bank loan 300,000. So again you are getting cash into the business 300,000. Now you have a liability, your right side liability 300,000. So left right gets equal in that case. So I think we did that the other day. I can show you. This is what we did. To get the asset, the business, and the capital. And when we get the furniture, you get the furniture, non-current assets, you are losing the cash, accounting equation get balanced, and you get the asset, cash from the loan, you have a liability. So your statement is getting balanced. And now let's move on to our question, right? And this one, we are going to do this together. We are going to do this together. So let's open this up. right? I will go to this one. Example 1. Right, this is the one. Okay, let's do this together. Nisal Mendis started a business to repair computers. The following transactions are given to you for the first month of business. For the first month of business. Invested 500,000 cash as capital. So we can be interactive in this session. So you can understand better if we interact better. So the question is, now the first one is invested 500,000 cash as capital. Invested 500,000 cash as capital. Now we are going to tell me how we put that into this equation. Right? Can someone share?
Increase assets cash by 500,000
Okay, you are getting cash assets 500,000. Okay,
and capital 500,000. That is equity.
equity under equity capital 500,000. Okay, do any one of you have a different answer? Thank you so much. No, no different answer. Okay, now invested 500,000 cash as a capital. Now we need to look at from the business point of view. So it's Nisal Mendis started a business to repair computers. It's Nisal Mendis business. It's not Nisal Mendis business. So you get cash 500,000 and the business is getting capital 500,000. You can see the equation is getting balanced. Probably we can bring this to here. Equation is balanced here. 500,000 cash, 500,000 capital. Right, 500,000 cash, 500,000 capital. The next one, obtain a bank loan of 200,000. Obtain, now the business is obtaining a bank loan of 200,000. Can someone tell me where that's going to affect?
Increase 200,000 liabilities and also add 200,000 asset.
Which asset then?
Uh, uh, Cash.
Cash, yes. The business is now getting 200,000 cash. Business is now getting 200,000 cash. That's easy. And now business is getting a bank loan. Business is getting a bank loan. So it's a liability. It's a liability. So we can put that under liability because business needs to pay that. We can say bank loan 200,000, and the equation is balanced. Equation is balanced. Then deposited 100,000 in a fixed deposit account. Deposited 100,000. Business is depositing 100,000 in a fixed deposit account. Now, what is that? Can someone share that? How that's going to affect? Can someone share that?
Asset increase 100,000 as fixed deposit.
Okay,
Also, asset decrease 100,000 as cash.
absolutely correct. So now the business is getting a fixed deposit. FD, it is a new asset, fixed deposit. It's a new asset. So fixed deposit asset, now value of that is 100,000, but you have to spend your cash or money to get that fixed deposit. So your cash will go down from 700,000 to 600,000. You will get a fixed deposit, you will lose. So you will get one asset, you will lose another asset. When one asset increases, another asset decreases. But the accounting equation is balanced. That is the beauty of this accounting equation. Right. And the next one, earned a cash income 60,000 from computer repairs. Earned cash income 60,000 from computer repairs. How we can treat that in the accounting equation? What we should do for that? Can someone share? Anyone want to share that?
Increase the cash and the equity.
Callum, line is not clear to me actually. It's breaking, it seems. Till Callum joins, anyone else can give the correct answer, or give not the correct answer, but can give the answer?
Asset increase 60,000 as cash.
Okay.
Equity increase 60,000 as income.
Yes, great. Now, earned a cash income 60,000. So business is obviously getting now cash 60,000. That's very easy. And there is an income. And so far we have not incorporated income and expenses to the business. But we said that the profit of the business belongs to the owner of the business. And how profit is generated? It is basically when you reduce your expenses from the income, you can get the profit. So income is your profit and expense is your reduction of profit. So here, since we have not yet incorporated income and expenses to the equation, we only have assets, equity, and liability. But now we know that income affect the equity positively. Expenses affect the equity negatively. Now this is an income of 60,000. So your profit will increase by 60,000. And profit belongs to the owner of the business. And that profit will increase the equity of the business. So equity will be 60,000. Then fifth one, paid 10,000 as the monthly rent of the business. Now this is a rent payment, an expense. This is an expense. Rent payment is an expense. So when income increases the equity, expense will decrease the equity 10,000. In the meantime, you are paying 10,000, or the business is paying 10,000 for rent, and your cash will go down. The business's cash will go down by 10,000. So asset is going down by 10,000. Equity is also going down by 10,000. So every time this equation is balanced, that is the uniqueness. Then the next one. Nisal Mendis withdraw. Hello.
Hello, excuse me, sir. Won't it go under liability? Is it?
Liability.
Yeah, 10,000. I don't understand. That's why I'm asking.
Paid 10,000 as a monthly rent. That one. Is that the one that?
Yes, sir, that is can't understand.
10,000, sir. Why minus? Because won't it goes under liability? Just we don't understand that.
Yes, yes. Okay. Now, let me ask you this question. What is a liability? Can you give your answer to that? What is a liability? Now you have to unmute and give your viewpoint. Otherwise, I can't understand.
It is our liability or responsibility to pay back.
Wonderful. Yes, our liability to pay back. So here we have already paid. Do you get the point? We have already paid this rental payment. So we don't have any obligation to pay. It's already paid. So it is an expense, not a liability. But let's say you have not paid the rental payment for that year or the month, then that's a liability. But we have already paid. So once you have already paid, then it is an expense. So expenses will reduce your profit. So expenses will reduce your profit means it will affect your capital negatively. So therefore, your capital will come down or go down by 10,000 and you have paid this. So your cash will go down by 10,000. Let's assume that you have not paid the rent payment for that month. Then you have not paid. There is no effect to cash. If you have not paid, there is no effect to cash. Cash is still the same. But it is an expense. So 10,000 is going to get reduced. But You have not paid. You have a liability to pay that to the owner of the premises, let's say. So then your liability will increase by 10,000. Here there is no liability. Again, if we go back, if we go back to the definition of a liability, it's our responsibility to pay that back. Now, if we move on to this one, here, payable of a business that had arose as a result of past transaction could be simply considered as liability. Liability arose as a result of past transaction. Outflow of economic resources when settlement is made, having a current obligation. So right now, since this is paid, we don't have a current obligation. So it is an expense which is already paid. Expense which is already paid. And liability is twofold: current liabilities and non-current liabilities. Let's say the liability that should be settled within a short period of time is the current liability. Non-current liabilities, all the other liabilities except current liabilities. So liability that should be settled within a short period of time is called current liabilities. Now, here it is something that you have paid as rent. It is not a liability, but an expense. Did I answer to the question? Is it clear now?
Yes, sir.
Great. Great. Thank you for asking that question like that. If you have any questions, please do raise, because in the online class, it's very difficult to figure out whether you got the idea or not, unless if you speak up. Right. The next one, the sixth one, Nisal Mendis is an owner. Owner withdraw 20,000 from the business for his private use. Okay. Can someone tell me the impact of that?
It is a reduction of cash by 20,000 and reduction of equity by 20,000.
Reduction of cash by 20,000. Yes, definitely. You are going to lose 20,000. The business is going to lose 20,000 cash. That's correct. And reduction of equity. Now, why do you say so, Pumali, right?
Yes, equity means that capital comes under equity, right? So
Yes.
he made the initial payment and now he is getting his money back. Similar thing.
Absolutely. Yes. When the owner is putting money into the business, the capital will increase. When the owner is taking money back from the business, his share will decrease. Capital is owner's share. His share will decrease by 20,000. And for this, there is a nice term is given for these kind of withdrawals. Taking money or any kind of assets from the business is called, do you know the name? There is a name given for such transactions. Drawings. Drawings. It's a drawing. Drawing is when the owner is taking money or any kind of assets from the business for his or her personal use. Now, if the owner is taking, let's say, not money, but he is taking a motor vehicle from the business for his personal use, that is called drawings. And drawings always reduce the capital. That means reduce owner's share of the business. And drawings always reduce the asset. It may be cash if owner draw the cash. It may be a machine if the owner draws machine. So the term that we give for such transactions is called drawings. For his private use, personal use. Now, number 7, purchase equipment at 100,000. Okay. Now, can someone tell me how to record that? Purchase equipment 100,000. Can someone share that?
Increase of assets and increase of equipments and reduction of cash.
Yes, thank you. It is going to affect 2 different types of assets. Now we are getting something called equipment. Equipment. Equipment is an asset. So we are getting equipment to the business 100,000. To get that equipment, you have to spend cash. So you are going to lose cash 100,000. So one asset increase, another asset decrease. There is no effect to this side, but you can see the equation is getting balanced. Right, another one. Paid 5,000 for the telephone bill of the month. Paid 5,000 for the telephone bill of the month. How do we record that? Telephone bill 5,000. Can someone say that?
Is it similar as monthly rent payment? Reduction of cash and reduction of capital?
Absolutely, yes. It's very much similar. It's an expense. It's an expense. So you are paying your telephone bill and you have paid it. So you are losing cash. You are losing cash. That's happened. You are losing cash 5,000. And in the meantime, it's an expense. Expenses will affect your profit adversely. You are losing your profitability, your capital 5,000. Then 9th one. Nisal Mendis invested an additional capital of 50,000. So Nisal Mendis, the owner of the business, is putting 50,000 as additional capital. So the business capital will increase by 50,000 and the cash will increase by 50,000. That's very straightforward. Final one, settled 20,000 of the bank loan. Now the owner of the business is settling 20,000 of the bank loan. Now bank loan is 200,000. So he is not settling the entire amount, but settling 20,000. So when settling the bank loan, the business is losing 20,000 cash because cash is being given to settle the bank loan. Now there is a liability of 200,000 as bank loan. Now we are settling 20,000. So that liability is reducing by 20,000. So now you can see your bank loan liability is not 200,000 but 180,000 because you have settled 20,000. So one asset reduce, another one asset reduced, and your liability also reduced. So accounting equation is balanced. So always this accounting equation should get balanced. So that is the most important thing. Most important thing. And the total assets should equal to the total liability. Total assets should equal the total liability. That is absolutely important. So, do you have any questions from this? No question.
So small question.
Yes.
Now, sir, equity hidden there in capital or the expenses also hidden there in the equity. So as we are modulate this equation, why can't we get separately mention the expenditure instead of equity? Now we have to think and get the equation. Now if we can put another column on expenses like capital and bank loan, finally the equation will be balanced. But in order to get the clear idea, as payment of telephone bill, payment of other expenses, we can categorize separate column the expenses also. No,
Where you want to take the expenses? Which side?
right hand side.
This side. Okay. Plus. Is that correct? This is
Yes.
correct?
Yeah, yeah.
Right. Let's remove one transaction and see. That's a very good point, actually. Which one we would take? This one. We can take paid 5,000 of the telephone bill of the month. Okay. Paid 5,000 of the telephone bill of the month.
Sir,
This one.
excuse me.
Yes.
Sir, please explain this last transaction, settle bank loan,
This one.
20,000. Yeah.
Okay. We'll do that first then. 20,000. Okay. Now, when it, okay, you can be, you can unmute. I may ask a couple of questions.
Okay. Okay. Sir.
Great. Settled 20,000 of the bank loan. Now, you have settled, the business have settled the bank loan.
Okay.
And for that, you have, the business has spent 20,000. Okay.
Okay.
So, do you understand that in order to settle, you have to give your cash?
No, this is different from the pay. I cannot understand this payment and the bank loan difference between bank loan and the payment. I suggest as a payment likewise, like this telephone payment of telephone bill, like.
Okay, payment of telephone bill. Now you are paying to settle the bank loan. Okay.
Yeah. Yeah.
You are paying 20,000 to settle the bank loan.
Yeah.
Right. That's very
Yeah.
correct. So you are paying 20,000 to settle the bank loan. When you pay 20,000, do you understand that your cash is going to reduce by 20,000?
Yeah, that is okay.
That is okay. Fantastic. And
this liability, how it's goes to the liability.
Okay. Now you have a bank loan, okay?
Mm.
And your bank loan amount is 200,000. Just think like that.
Mm.
And now we are settling 20,000
Mm.
because let's say we have a bank loan and
Mm.
every month we have to settle that some portion of that.
Mm.
That's how it is. Now if we take a personal loan, let's say 100,000, let's say 1 million,
Mm.
then every month we have to settle a portion, okay?
Okay.
And then what happens? The loan amount get reduced.
Mm.
Here also, you have a bank loan of 200,000
Mm.
and you are transferring funds to settle that loan by
Mm.
20,000. So now your loan is no longer 200,000 because you are settling 20,000.
Mm. Mm.
So it comes to 180,000. It is not an expense, but reduction of the loan. And of course, in the real world, there is no interest portion here for the benefit. I mean, to make it very easy. But if you have an interest portion, that interest portion is your expense, and the capital reduction of the loan is the one that you can reduce here. We have not talked about that in this question, and we probably will not talk about that. But ideal world, when you are settling a loan, that your installment contains two portions. One is the interest portion, the other one is the capital portion.
Mm.
And the capital portion will be the reduction of capital, this 20,000, and the interest portion will come under expenses. Did I answer to your question? Is it clear?
Okay. Okay, sir. Now clear.
Okay, so your liability will come down, and now you have to settle only 180,000 or 200,000.
Okay.
Great. Okay, now we are
Okay,
coming to
thanks,
the,
sir.
no worries. We are coming to the earlier one. I think Callum, right? You wanted to put these expenses under expenses into the right side, right? You can unmute so we can have the conversation and others will get benefit also. Is that right?
Yes, sir. Right.
Now the equation is correct, right?
Yes.
Fantastic. So let's delete this one. Now the equation is balanced. And let's take that. Paid 5,000 for the telephone bill of the month. So it's very easy. You pay 5,000 cash. That's correct, right?
Yes, that's correct.
And you say instead of putting this here, we need to put these expenses 5,000. It's an expense, telephone expense 5,000. And the equation is not balanced. So what is your suggestion, Callum?
The money in hand kind of equity or the capital, it has to deduct the amount we spend for the telephone bill as per 5,000. Then again, the equation will balance things.
Sorry, can you repeat it again? I didn't get it, Callum.
Now, sir, the equation now expenses, though we have mentioned 5,000 separately in order to understand it easily, but it has not take into account the money at hand, like 760,000. No, it has to deduct 5,000 from that one. Then again, 755,000 will come.
Now we have put minus 5,000 to the cash because we are losing cash. Okay. And telephone payment is an expense. So we put 5,000 under expense. Is that correct?
In order to get to know the expenses separately, correct. But in order to get the cash in hand, we had to take that 5,000 also into the equation. No, then again
No, we have taken cash in hand in the sense now, this is the cash in hand. This is the cash in hand.
Okay.
So we are losing 5,000 and now cash in hand. Now we have 560,000 cash in hand, and now we have paid 5,000. So now our cash in hand would become 555,000. And on the other hand, there is an expense, which is 5,000. So it will not give us the balanced view. Let me suggest a different thing.
So he's saying, I think that 5,000 should be as minus 5,000, that expenses.
Expenses minus 5,000.
That's what I think he's saying.
Is that so?
now expense separately mentioned there, sir. Now it has to deduct from equity or the equity side. No, sir. Now minus 5,000 from that equation.
Okay, let me do like this without making things complicated. Right? So instead of putting expenses into this side, I put that in this side and corresponding income this side. Why income this side? So income would have a positive impact towards equity. Expense would have a negative impact towards equity. And paid 5,000 of the telephone bill of the month. You are paying 5,000, you are losing your cash 5,000. And it is an expense, telephone expense of 5,000. Right? So that's a very good point that you brought up, Callum. Now, so far we discussed that assets equals equity and liabilities. And we were about to talk about the full equation. We were about to talk about the full equation. So when it comes to the accounting equation, full equation, it is assets plus expenses equals equity plus liabilities plus income. So full accounting equation is assets plus expenses equals equity plus liabilities plus income. Now, if we change some of the if we change some of the expenses and income here, right? If we move on to the example number 4, earned a cash income of 60,000 from computer repair. Cash income of 60,000 from computer repair. You are getting cash 60,000. You are getting an income 60,000. You are getting cash 60,000. You are getting an income 60,000. Now you can see that. Let's see. We'll take this bit of formatting to make it little more beautiful. Okay. And another one. Paid 10,000 as the monthly rent of the business. This one, paid 10,000 as the monthly rent of the business. So you are losing cash 10,000 and it is an expense. It is an expense, rent expense 10,000. And we can also include a new column here and we can say rent expense. Rent expense 10,000. The other expense is telephone. Rent expense 10,000, and this one is the telephone expense. Now it's more comfortable, right?
Yes, sir.
Yes, it's more comfortable. Now I think this one, J14. And this one also we need to bring, let's say, sum of all these. What happened? Then sum of all these. So now you can see the distribution. Now these are expenses and these are assets. And these are equity plus liabilities. These are current income. So yes, that's a good point, and that is what we wanted to discuss. The initial accounting equation is assets equals equity plus liabilities. But there is an income and expense portion for that. But remember, what we did was correct, because increase of income will increase your capital. Increase of expenses, expense වැඩි වෙද්දී අපේ capital අඩු වෙනවා, decrease the capital. So we have incorporated that into capital. But now instead of doing that, this gives more clarity. So you expand the accounting equation, which says assets plus expenses equals equity plus liabilities plus income. So this is the complete accounting equation, and there won't be any further addition. There won't be any further addition. So this is, if you know this one, then you can do any questions. Let me ask this question from you. Do you have any questions related to this one?
So now in dual entries, sir, in cash book, normally we know left hand side the cash inflow and the right hand side the cash outflow. Now when you consider that situation into here, the expenses has come to left hand side, whereas the income has gone to right hand side. That's the little confusion. Though now, since your explanation we can understand, but according to
I didn't get you. Okay. Can you repeat it again?
yeah, so now in dual entry cash
Yes.
book, left hand and right hand side is there.
No,
Normally,
we have not come to cash book or dual entry. I mean, you are referring to the T accounts, right?
T account, but
Yes, we
it's
have not come to T account
uh,
yet.
without going for that also, sir. Now since the left hand side, we normally used to know the cash inflow or whatever credit, and the right hand side debit. So therefore, that principle we can.
Again, that is T accounts, Callum.
Ah, sir. Okay.
Now, this is the concept.
Concept.
And
Yeah.
yes, without knowing this concept, if we go to the T account, then you will miss the logic. But then you remember, okay, left hand side is this, right hand side that. So that is not going to work actually.
Okay.
So the logic, the accounting equation always says assets plus expenses equals equity plus liabilities and income. And based on this, we develop the T account. And you are correct. In the T account, left hand side is your inflow, right hand side is your outflow. For some accounts, that is correct. For some accounts, that is not correct. For cash account, that is correct. But for your credit accounts, that is not correct. Okay. So this is not that actually. This is the concept. It says accounting equation, assets plus expenses equals equity plus liabilities plus income. Okay, we'll come to that. So then I will ask that question from you, or you can ask that, Cal. Any questions related to this?
So that 10,000 case, that monthly rental case, that
Yes, this one.
oh, that it should be in the right hand side equity also from it should be deduct, no?
Equity should be deducted. Why?
10,000. Here that only from the cash that 10,000 deduct only from cash assets.
No, we have deducted 10,000 from your cash.
Cash
and
also
we have identified the expense portion of that. That is
right.
rent. So once we identify the expense portion of that, it means that we have incorporated that into equity in the
equity. Right.
Yes.
Right.
Because when it comes to equity, again, you can see your total expense is 15,000. Now we can build a profit or loss statement as well. So your total income is 60,000. Your total expense is 15,000. So your profit is 45,000. Total income, this total expense. We can build our profit or loss statement as well from this question. Okay, shall we build a small one for increase our understanding? Now, let's say this is our profit or loss statement. Profit or loss statement. Profit or loss statement of Nisal Mendis company, let's say. Total income is 60,000. we put here to make it little beautiful. Is 60,000 profit or loss state. Expenses. You have two expenses. One is your rent expenses. Rent expenses 10,000. Then you have telephone expenses 5,000. Total expenses. Profit or loss. In this case, it's a profit. Profit of 45,000. And we can build the balance sheet as well. Don't worry too much. We'll come to that. But since I mean, this is a very straightforward one, I will try to create the balance sheet as well. Let's say statement of financial position of Nisal Mendis company. This is also called balance sheet in other words. Then this is a very basic one, your total assets. You have your non-current assets. And you have your current assets. Non-current assets, current assets. Then your capital and liabilities. This is your total assets. This is, sorry, equity and liability. And this is your capital. This is non-current liabilities and current liability. Okay, we'll mark these things in a different color. Right. Great. Non-current assets. I'm asking you, do we have a non-current assets here? Can someone say whether we have any non-current asset?
Furniture.
Equipment. Equipment. 500,000. Total, sorry, 100,000. equipment 100,000. Then we have current assets. What we have? We have fixed deposit 100,000. And we have cash 555,000. So altogether, our total current assets is 655,000. So our total asset is this one plus this amount, 755,000 is our total asset value. Right. Then we know our total asset is 755,000. When it comes to balance sheet or when it comes to statement of financial position, total asset should equal to total liabilities. So let's see whether our total liabilities are the same. Total liabilities are the same. So the capital value is our capital value is 530,000. And the profit belongs to the owner. And profit will increase the total capital. Our profit is how much? 45,000. So total value here is this one plus 575,000 is the, sorry, this is, and put this, that is the total capital value. And non-current liabilities. Do we have a non-current liability? Bank loan. Bank loan is a, since we have only one here, our bank loan is the non-current liability. We don't have any current liability, so it's 0. And the total here, capital and liability is this one plus total equity and liability. Okay, now you can see here total assets equals total equity plus liabilities according to the balance sheet. So I think we come very far here accounting equation is expanded by adding expenses and income, and from there we were able to derive profit or loss statement of Nisal Mendis company and the statement of financial position of Nisal Mendis company. So the finally we figure out the when it comes to profit or loss, it's income and expense difference 45,000, which belongs to the owner, and increase the capital. So statement of financial talks about this very same thing. So when it comes to statement of financial position, now this is key. When it comes to profit or loss, now income and expenses, income and expenses comes under profit or loss. Income and expense comes under profit or loss. Assets and equity plus liabilities comes under balance sheet. So profit or loss talks about the performance of the company. Performance is measured by the profit. Performance is measured by the profit. So statement of profit or loss talks about the performance of the company, whereas balance sheet or statement of financial position talks about the position of the company, how much assets that a company has, position of the company. Higher the assets, better. And how the asset composition is being made. Now, the total asset is 755,000, and how that assets is built, owner's equity. Out of that, owner's equity is 575,000. And then the liabilities 180,000. So this is called equity capital in accounting. This is called debt capital. How the capital or the total asset is formulated or formed. 575,000 from equity capital, 180,000 from debt capital. Naya pragdaneng 1,80,000 equity capital. Kelima owner capital 575,000. So we will get to know more about statement of financial position and statement of profit or loss much better in future questions. But this is the critical part, accounting equation. Do you have any questions from the accounting equation? Okay. Right. So what should we do? Do you all need a break or can we continue? What do you say?
So better to have breaks.
Yes. Let's take a break now. And okay, let me share this. Now, we have where we were. Okay. Now we did this question, and after the break, I mean, once we join, we want to do this question. And this is very important. And when we are doing this question, let's focus on the full equation, not the short form, but the big one, including income and expenses, incorporating income and expenses. Okay. So let's meet at 12:30. Let's meet at 12:30.
Okay, sir.
And after that, let's do this question. And I will give a few minutes for you to try this out. and after that we'll do this together. But I want you to try this out on your own, this question. Okay,
Okay, sure.
right. Okay, thank you. So let's meet at 12:30 then. And hope you all have these slides and all by now. Hi again. Good afternoon. Are you all back? Hello. Hi. Are you all back? Or still not?
Yes,
We-
sir. We are here.
Yes, sir.
Right. Great. Fantastic. So, can you see the screen as well?
Yes, sir.
Great. So now um, we are going to do this example, and I hope you all have this question. But if not, now I have shared it. So what I want you to do is I will give you about 10 minutes, not probably more than the maximum 15 minutes for you to enter these transactions into the accounting equation. Enter these transactions into the accounting equation, like what we did here in the earlier one. So put this into the accounting equation and also have a separate columns like this for different types of assets, different types of expenses, different types of liabilities and income. So we have an expanded accounting equation, and ensure that both sides are in balance. So right, something like this. Can you all start now? We'll give you probably till 12:45. We are going to work with this on your own, and thereafter we can do this together. Right. So you all can start now. And if you have any questions, I'm on the call. Just ask.
Hello, sir.
Yes.
Regarding purchase goods at 100,000 on credit basis, these goods goodies come to under assets.
We can put that under stocks.
And this will be credit basis, so this will be liabilities.
On credit basis means we have not paid cash, so that is a liability. Are you all done? Or do you need a couple of more minutes? Or shall we start working together?
More minutes.
Okay, we'll give a couple of more minutes then. Shall we do this together?
Okay, sir, we'll do together.
Yeah. How far that you have come to? Are you all done, or like up to which level?
Done, sir.
Okay, great. So then let's see how it goes, and you can verify your answers here. Okay. The following balances were shown as at 1st of Jan 2021 of Mahangu Tirimana's business. Motor vehicle 500,000. So there is an opening balance. So let's let's put that opening balance. Motor vehicle 500,000. Then stocks 200,000. Then cash 100,000. Bank loan 200,000. And creditors 100,000 and capital 500,000. And let's put the sum value here. And here also. No, so let's take the total. Right. Sorry. So the amount is balanced. So opening amount is also should get balanced. So it is balanced. First transaction, owner invested 200,000 cash as additional capital. Owner invested 200,000 cash as additional capital. So I am doing this question now. And if you have any questions, then please raise. Okay, please disturb me, interrupt me, and raise to save the time. I will not ask from each and every one of you. So I am doing it. Okay, owner invested 200,000 cash as additional capital. So our cash will increase, or the business cash will increase by 200,000, by 200,000, and additional capital, the capital balance will increase by 200,000. Do you have any questions on that transaction? I hope. No, it's very straightforward. Okay. Then paid 20,000 bank loan installment. So there is a bank loan here, 200,000. And now you are paying 20,000 to settle the bank loan as one installment. So when you pay, you're losing 20,000 cash, as well as the bank loan is now 200,000. Now you are settling 20,000. So ideally the loan amount is get reducing. So you are settling the bank loan will get reduced by 20,000. Okay. So it is 180,000. Do you have any questions from that one? It's very similar to the earlier one. No questions. Okay, the third one, purchase goods at 100,000 on credit basis. So there are two ways to tackle with this. So at this point of time, I will tell you one way of that, and in future, I will tell you the other way. So purchase of goods, we can consider as stocks. So your stock value will get increased by 100,000. Sorry, there is a disturb. So purchase good 100,000 on credit basis. Stocks will go up by 100,000 now on credit basis. Now here I am going to ask you this question, since it's an interesting one. So what would happen to that? On credit basis? Can someone explain? On
Is it
credit
kind
basis.
of liability or something like that?
Absolutely, kind of liability. So it is a liability. So you have a creditor of 100,000. So the creditors will increase by 100,000. So you already have had a creditor by purchasing probably on credit. Now that credit value increase by 100,000. So your stocks asset will increase by 100,000. Your creditor liability will get increased by 100,000. Paid 50,000 to creditor. Now we are paying 50,000 to creditor. So you are going to lose your cash 50,000. Cash will go down by 50,000, and creditor will also go down by 50,000. Right now you have 200,000, but it will come to 150,000. And then owner gave 200,000 worth of his private motor vehicle to the business. That's a very interesting one again. So can someone of you explain that? Owner is giving his motor vehicle to the business.
Motor vehicle. Increase by 200,000. Equity increase by 200,000.
Absolutely. So motor vehicle, the company will get a new motor vehicle, so it will increase by 200,000. And similar to putting money, now this owner is putting motor vehicles. So capital will increase by 200,000. Then sold, this is a tricky one. Okay. Sold goods which cost 100,000 at 150,000 on credit. Sold goods which cost 100,000 at 150,000 on credit. The tricky one. Can someone explain this? Sorry?
Assets reduced as stocks, sir, by 100,000.
Okay.
And assets increased as debtors, 150,000.
Okay.
And profit, 50,000 profit that is belongs to owner. That is capital profit increased by 50,000 under capital.
Is this correct? Stocks reduced by 100,000. Then the debtor increased by 150,000 and the capital increase, that is profit, 50,000. Is that correct? Can you let me know whether what I put here is what you have intended?
So that is what I.
Great. Anyone else has a different answer? Anyone else has a different answer?
So this 50,000 to be a income, no?
This one.
This 50,000
Yes,
is to be a income, no?
income. Since we have, both of you are correct. Since we have this income incorporated, we can say sales income. Now it's much better, right? Right? Now it's much better, I think. Beautify this a bit. Okay, so you got the point here. Sold goods worth of 100,000 at a price of 150,000 again on credit. ඒ කියන්නේ ලක්ෂයක බඩු ටිකක් ලක්ෂයකමාරකට විකුණලා එතන profit එකක් තියෙනවා. profit එකක් නෙවෙයි. අපි income එකක්, sales income එකක් විදියට තමයි ඒක ගන්න. profit එකට තමයි add වෙන්නේ at the end of the day. So sales income එකක් තියෙනවා 50,000. So what you are going to lose is your stock of goods 100,000 and you are not getting cash for that. Instead, the debtor is being created. Debtor asset is created 150,000. So the difference is your sales income. That is 50,000. So let's put that under sales income. Anyway, that's part of the profit. So if you identify that as a profit and effect to the capital, that's correct. But since we have income and expenses incorporated to this equation, then let it be like this, considering it under income. Okay, then paid 10,000 for insurance. Paid 10,000 for insurance. So your cash 10,000 will get reduced. And now you have an expense, insurance expense. Insurance expense. That is 10,000. Insurance expense 10,000. You are reducing cash 10,000. The equation is balanced. Then receives 70,000 from debtors. Now there is a debtor 150,000 and you are receiving 70,000. So your cash will increase by 70,000 and your debtor's value goes down, debtor will decrease by 70,000. So now the debtor balance is 80,000 and the cash balance has increased to 290,000. Then paid 5,000 from the business for the electricity bill of owner's house. වෙනස් එකක්. Owners ගේ ගෙදර electricity bill එක office එකේ සල්ලි වලින් ගෙවලා තියෙනවා. Can someone explain that?
It's drawing, no, sir? One.
It's drawing. Absolutely correct. Okay. Have you record it?
Both cash and capital decrease.
Yes, brilliant. The cash reduced by 5,000 and drawings capital will reduce by 5,000. Finally, receive sales commission income 10,000. Another income, commission income. You are having commission income of 10,000 and cash will increase by 10,000. So now you can see after these 10 transactions, both left side and the right side got balanced. The theory is very simple. Assets plus expenses or expenses plus assets, expenses plus assets equals equity plus liabilities plus income. Expenses plus assets equals equity plus liabilities plus income. So now based on this, again, we can do the profit or loss statement and the balance sheet. So let's take a copy of this and we can now this is Mahangu Tirima. Tirimana company. Now take the total income you have instead of these different expenses. Okay, let's put like this. Let's insert 3 columns here. Okay, total income. Then we have 2 types of income: sales income of 50,000. And we have commission income of 10,000. So total income here is total income is 50,000 plus 10,000, 60,000. Then you have expenses. You have insurance expenses. Expenses of 10,000. So your profit is 60,000 minus 10,000, 50,000. 50,000 is your profit. Then here talk about the assets. So you have non-current asset, that is motor vehicle. Motor vehicle, the amount is 700,000. Then you have three current assets. Three current assets. We'll insert a column here. Stocks. We have stocks. Stocks value is 200,000. Then we have cash. Cash value is 295,000. And then we have debt. Usually when we write from the higher lowest liquid asset to highest liquid asset. So let's take debtor first and then take cash. So highest liquid asset at the bottom. Total assets, it's 1.275 million. And then liability, equity and liabilities. That's good. Capital amount is 895,000. Profit is 50,000. And the non-current liability, we don't have a, yes, we have a bank loan of 180,000. We have current liabilities. We have a current liability. That is creditor the amount is 150,000. Right? Now you can see total assets equals total equity and liability. Total assets equals total equity and liability. Great. Now, do you have any questions from this? Is it clear or crystal clear? Is it clear? Yes or no? I want to hear your responses. Okay, Rochelle, thank you. Others, how do you say?
Yes, sir, it's clear.
Great. Fantastic. So with this, we were able to apply these expenses, assets, accounting equation, expenses plus assets equals equity plus liabilities plus income. And also now you got some kind of an understanding about the statement of profit or loss and the statement of financial position as well. So income and expenses are part of the profit or loss statement, and assets, liabilities and capital are part of the balance sheet. So actually these assets and capital, equity and liabilities, these are balances. These accounts have balances. So that's why it is balance sheet. These are income and expenses. They don't have balances. They are already incurred. They don't have balances. Now, if you look at an asset, a machine, now after an accounting period, now machine has a value. So there is a balance. Okay, value of the asset after the year is, let's say, 100,000. So in the next year, the value at the beginning, it's the same. So there is a balance. So that's why we call balance sheet. So every asset, every liability. So there is a liability and it's a balance. Okay, we have this much of amount that is required to pay. But income, we have an income. It's already, received. Expense, we have already paid. There is no balance in that. It's just income and expense. So that's why we call this statement of financial. Historically, we were calling this as balance sheet. Excellent. So let's move on to this one. Yes. Yeah. Okay. Yeah. 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 Yes. Yeah. Now, in the market, the prices have gone up, but now your stocks were purchased earlier, right? Earlier. So then, when you show that in the accounting books, you can't get the market price and show that in the accounting books. So you always have to use the historical rate. That is because to protect the owners. Otherwise, what would happen is, now let's say you bought a let's say one unit of steel for the understanding purpose for 100,000. ලක්ෂයක් වේදන් කරලා steel unit එකක් ගත්ත කියලා අවුරුද්ද මුල. And when you are going to purchase that at the end of the year, let's say ඒක ලක්ෂ දෙකක්. But now the stock that you purchase at the beginning of the year is still with you. And now that is part of the stocks. And now you are preparing your accounting statements. So you have to take the historical rate. You can't take the market rate and include that in the accounting statement, because then what would happen? Then, the accounting guys will try to inflate the things and inflate the profitability. But now let's say you have resell or you have sold it for the price of 200,000. Of course, then it is a realized gain. Then you can include that in the books. But until it is realized, we can't recognize the market rate. Did you get what I mean? Yeah. So if you have something remaining as stocks, then we have to take that to the historical rate. But there is only one exception. Now you are going to sell your company and you are going to revalue your company. And then at the revaluation, you can take the market value. So there is a revaluation gain in that. But other than that, historical rates need to be taken. Okay. Yeah. Yeah. Yes. Now that is not a gain, that is a liability. Okay. Bank loan in the sense now bank loan has increased, the rates have increased. And if you are, I mean, you are saying that you are using these, what do you call, variable rates or the fixed rates, variable rates. Yes. So then you have to account that on the spot. Because it is realized, right? Yes. And also there is another difference. Now, if it is a gain, you have to wait till it get realized. If it is a gain. But if it is a loss to the company, you don't need to wait till it get realized. You need to recognize that. Two different approaches actually for gain and losses. That is again to protect the owners. So what would happen now? You foresee a loss and you are not recording that, because if you record that, your profit will go down, but you can't do that. So when it comes to a gain, you have to make sure that is realized to record that in the accounting books. But when it comes to a loss, yeah, when you foresee the loss, you can report that. You have to report that. Two different approaches, but to safeguard the revenue. And there are different, when you read these accounting concepts that I said, matching principle, accruals principle, you can get an idea about those as well. So when you have a variable rate for the loans, of course, then you have to use the variable rates, and the fluctuations need to be recorded, because that is the contract that you agree, and with the variation, once the variation happen, you can record that in the books of accounts. Did I answer to the question? Great. Now let's say a company is having a motor vehicle. Now the motor vehicle, now let's say the company bought that motor vehicle 10 years ago, Toyota Corolla. Company bought it for 50 lakhs. Now the price is 100 lakhs. That is reality, right? 100 lakhs. Yes, it's true that the value of that asset is now 100 lakhs, but you can't record that as 100 lakhs because you have brought it for 50 lakhs and you have to record that under historical rate. Because if you record that under the current market rate, then it will be a gain, and gains are not recorded under the market value, but the gains are recorded under the historical rate. So assets are recorded under the historical rate if there is a increase in the price. But let's say you bought that asset for 50 lakhs and now the price is 30 lakhs. So that is depreciation. So you have to consider the reduction of the value of the asset under depreciation. Now, usually nowadays motor vehicles are appreciating, but you are not recording that appreciation. But you can have a limited amount of depreciation. Yeah. Okay, then build the accounting equation. These are drawings. I think we did. Now you can see assets plus expenses equals equity liability plus income. We discussed that. And I want you to do this one as well now. And for this one, probably maximum of 13 minutes, I can 12 minutes I can give you. Take a piece of paper, it won't take 5 minutes. So please do this question now. Oh, probably this one we have already done. Is it the same? Yeah, it's the same. Question 1. But incorporating income and expenses. So take 10 minutes and do this, complete this. And I will not do this, but I will ask whether you have any questions. So do this now. Full equation. Right. Have you all done it? I just put a copy paste thing actually. So we did that here. So the same applied. Okay. Right. Before taking the break, are you all right if you take the break at 2 p.m.? Will that be fine with you? Can a few of you raise the voice, please?
Okay, sir. No issue.
Anyone of you have any issue? Okay, let's take the break at 2 p.m. Or probably before that. But I want to showcase one interesting thing here. And you need to listen carefully. Now, when it comes to this accounting equation, now you know assets plus expenses. Assets plus expenses equals equity plus capital plus income. So if we write here, assets plus expenses equals capital plus liabilities plus income. And this is very important. This is the most important thing in accounting. First most important. There are another thing that is also very important. Two most assets plus expenses equals capital plus liabilities plus income. Now, I am going to showcase you how this is enter in ledger accounts. Ledger accounts. Now, when it comes to the ledger accounts, you might have seen something like this. I am sure you might have seen something like this. T accounts. Have you seen T accounts? Have you heard T accounts or ledger accounts? Yes. Something like this, T accounts. So when it comes to T accounts, or when it comes to T accounts, there are two important terms. Two important terms. Debit and credit. Debit and credit. Have you heard debit and credit? It's either me explaining everything or it's having the conversation. My preference is to have the conversation, but I mean, if you don't want this conversation, I can like continue without asking questions. Okay, right. So when it comes to the T accounts, there are two terms, debit and credit. And how debit and credit arise is that when there is an increase in assets or increase in expenses, we call it debit. When there is an increase in assets or increase in expenses, we call it debit. When there is an increase in capital or increase in equity, increase in liability, increase in income, we call it credit. Now, if I draw or probably insert, let's insert an arrow. Okay, if there is an increase, then we call it debit. If there is an increase, then we call it debit. That is this side. And if there is an increase in this side, we call it credit. We call it credit. Increase in assets or expense, we call it debit. Increase in equity, liabilities or income, we call it credit. And on the other hand, decrease in this side is credit. Decrease in this side is debit, vice versa. So increase debit, then you will see decrease in this side is credit. Decrease in this side is credit. Likewise, decrease in this side will be debit. So that is how this is a logic. This is a logic. Okay, this is a theory. Increase in assets or increase in expenses, debit. Increase in equity, increase in liability or increase in income, credit. Or else vice versa, decrease in this side or decrease in assets, decrease in expenses, credit. Decrease in equity, decrease in liability, or decrease in income, debit on the other hand. So the T accounts are built based on this principle. T accounts are built based on this principle. So there are two main principles. One is the accounting equation. Accounting equation says assets plus expenses equals equity plus liabilities plus income. That's the first thing. And the second thing is increase in assets or expenses. One side of the equation is debit. Decrease of that side is credit. Increase in the other side of the equation is credit. Decrease is debit. And based on that, we create the ledger accounts. Now, if we look at the ledger accounts, now if I draw a ledger account here, let's say this is the ledger account. Okay, so first transaction entered or put 500,000 capital, 500,000 cash to start off the business, 500,000 cash to start off the business. And now we want to put that into, instead of writing this in this equation, we are putting down into the ledger accounts. Why we are putting down into the ledger account? Because writing down in this equation is impossible. Companies have 1,001 types of assets, so much of different types of expenses, a lot of liabilities and income sources. Therefore, this equation will get expanded, and you will need more than probably 10,000 rows to cater to the account, to handle the accounting equation. So that is not possible. Therefore, we put ledger accounts, we create ledger accounts to handle all these transactions. And nowadays we don't even have ledger accounts in this nature, but we have computerized software systems. So system does handle this very efficiently. So historically people were using ledger books to record the ledger accounts. They were so manual. Nowadays companies are using, almost all the companies are using computerized systems. So if we take this example, the owner of the business invested 500,000 cash, to start off the business. We have two accounts getting affected, and now we know that two accounts are getting affected, and now we know what are the two accounts. One is business cash account will get affected, cash account will get affected. The other one is the capital account will get affected, capital account will get affected. And now we know that this side increase is debit, this side increase is credit. So now we take this increase effect when it comes to ledger accounts creation. We take the increase effect when it comes to the ledger account creation. So this side is a debit side, we call it DR. This side is a credit side, we say CR. This side DR, this side CR, debit and credit. So debit and credit. So now what's happened? Let's increase this a bit. Okay, you invested 500,000. So the business cash account, transaction 1, business cash account, cash increased 500,000, means asset increase 500,000, asset increase of asset debit 500,000, increase of asset or increase in asset debit 500,000, and the equity is increasing, increase in capital credit 500,000, increase in capital credit 500,000. That is the first transaction. So you put the figures here, and then you have to write the name of your contra account, name of your contra account, name of the corresponding account. corresponding account to figure out the dual impact, the duality. Here, cash increased by 500,000 because of the capital, and the capital increased by 500,000 that comes as the form of cash. So that is how you do this transaction, ledger account creation. So cash increase, debit 500,000, capital increase, credit 500,000. And that is how you do the double entry, or how you do the double entry and how you do the ledger accounts. So do you have any questions? Right? No questions. And then let's take a break now, and lunch break, and let's meet around at what time? Do you want 1 hour, or are we good in 45 minutes?
1 hour.
1 hour. Okay. Let's meet at 3 o'clock then. 1 hour lunch break. Let's meet at 3 o'clock. Okay.
Okay, sir.
Right. So 3 o'clock is the time we're gonna meet.